Thanks for joining us. Welcome to Sightline's second investment trends report webinar. We're really glad to have you with us after, gosh, I don't think we could have timed this for much more of a busy and better time to be gathering and talking about the state of climate tech, huh? Um, I've got some dorky comments here about how America got busy on its birthday. Trump certainly did not waste any time with grilling up more than just a barbecue with all of these sparks flying with his one big, beautiful bill passing on July 4th. 940 page package, which I believe is pronounced as huge. All right, folks are going to kick me off of the stage here to kick us off, but we're here to give you the so what and then really transition into the now what, right? And in 940 page package, there's an infinite amount to cover. And of course, within that, a majority is not related to climate tech. America is making some really fundamental changes to its kind of governance strategy here. Lots of folks are kind of figuring out what's happening in real time and reeling and coming together. We put out a breaking real-time report, which I hope that you guys were all able to follow along in the newsletter, passing just this Monday. And we're here to talk about it and to tie it back into what's happened over the last full 6 months prior to that, because it structurally really feels like there's some fundamental changes happening with what's going on in climate finance, and especially at the early stage venture side of the spectrum. If I had to summarize what's happening with OBBB, BBB, triple B, one big, beautiful, huge bill, it kind of just feels like what's old is new again, right? All of these changes to tax credits, which are really the main engine of our Inflation Reduction Act, clean energy push. It's now fossil fuels and incumbents that are back winning big. We've got clean energy fundamentals of our solar, wind, EVs getting hit hard, and transferability, some clean firm sources persist, we hope. So net, I'd say it's a bunch of flashing red, yellow, green kind of signal lights across all of these different sub-technology and industry areas. And we're here to settle in. It's been paused. And so, if anybody in infrastructure and deployment likes anything, it's certainty and stability. Regardless of kind of specifics of the content, at least we're there. And so it's time for us to really settle in, understand, talk about it, and move forward. So throughout this webinar, we're going to be bringing the whole dream team up onto the stage. Kim, Mark, Julia, and we're going to be talking about a bulk of conversation, less on the kind of what's done is done and more on the now what and the go forward. How do we move forward in action? What's happening in the space from here? So here are our four faces. We're covering highlights, big themes, looking back over the past 6 months, sector by sector. What do the numbers say? Some really foundational changes, I'd say, over the past 6 months or so relative to the past 5+ years that we've been running all of these numbers for y'all. And then we'll dive deep with Julia into the stages and the sectors. This is very different landscape, industry by industry, sector by sector. And then we'll pull Mark up to reflect a bit on what we thought was going to happen, what's actually happening, and then more importantly, where do we go from here? At the end of that, all of us are going to pop back on stage. We're going to be engaging with questions that you all will submit through the Q&A button down the bottom. So feel free to please engage with that and drop in anything. You can get started right now if there's a question that's top of mind. I'll be keeping my eye on that throughout the entire webinar. And we'll weave in some of those questions during that group discussion at the end, which we're going to reserve quite a lot of time for. So because this is so real time, we've obviously got our very prepared kind of perspective on it, but we also want to engage in real time with you guys. And we hope that this can be kind of a bit more of a live-esque discussion this go around. So put those questions in the Q&A box. We're also going to be popping up a series of polls throughout the session. And nothing better than to warm everybody up and make sure you all have your coffee and your keyboard ready to go. This is not a passive webinar, so let's try this one out. First question, you guys love a Zoom poll by this point, but what are we actually calling this one big beautiful bill? We call it one big beautiful bill. It feels like a little bit of a mouthful. Is it BBB? This is my favorite. Is it the OBBB? Triple B, B's knees? Pop your funny little response in there, and we'll make sure that you guys are awake and that the poll is working. Julia's manning this on the back end. Thank you so much. I'll give you a countdown. 3, 2, 1. All right, let's close that out and make sure that this is all working. Great. All right. Oh, actually, that's closer than I thought it was going to be. Okay. We'll be feisty. Maybe, Tim, you can keep to your OBBB and I'll keep to my BBB. Right before we bring Kim up, I'd be remiss to not mention that we just put out a massive H1 25 report via Sightline. It also went out through CTVC. We're going to drop the link to that public report out in the chat. Download this report. It's got kind of seemingly infinite information in it. If you're a client, there is literally more detail behind all of that. So head over to the Sightline platform to download a significantly more detailed version of our half-year report. I'm being told that we've already had, many hundreds of downloads on that, and it was testing our systems with how many people were trying to download that report just over the weekend. So make sure that you've got that up as well. Okay, we've got polls, we've got Q&A, and we're going to bring Kim on up here to kick it off with the now what for the OBBB, BBB.
I guess we're gonna call, but BBB is Build Back Better. I don't know. It's confusing. But yeah, thanks Sophie for that great intro. And I think, Sophie kicked us off well, right? Where we're doing this webinar right in the wake of the OBBB. And so what I really want to talk about today is what are some of the highlights, big themes we heard from the OBB, and how is that being reflected in even the last 6 months of investment trends? So a couple key themes, mainly sunsets and a couple of bright spots. So let's unpack at a high level who we think were the winners and losers of the OBBB. On the winner side, I think undoubtedly lots of provisions in there for fossil fuels, oil, gas, and coal. In terms of bright spots, surprisingly, I think extensions for clean firm power solutions, so nuclear, geothermal, storage, were for the most part exempt from some of the phase out of credits. Biofuels, transferability, and carbon management as well actually stayed the course. So definitely some bright spots there, not all doom and gloom for energy, clean energy overall. But on the loser side, solar and wind were definitely the hardest hit, which we can talk a bit more about. Consumer electrification as well, the EV credit, home electrification provisions were also really hard hit. And then hydrogen and supply chains took a beating as well. So a lot of requirements for an entity of concern, which we'll talk about. And the main takeaway really from OBBB is that the US is now taking a really all of the above approach for energy. So it's no longer just fully focused on decarb, fully focused on clean. It's really all of the above. And there's going to be a race to placed in service by December 2027, especially for solar and wind, given that phase out. So despite the overall sentiment on solar and wind sort of losing out in this bill, there will be a short-term race to get as much in construction as possible, which we'll talk about. So going a bit deeper into the specifics here, there's a lot to unpack in this bill. Obviously, not all of it is focused on energy, 940 pages, but the key things to know about, to keep in mind here, first is the clean electricity production credit and investment credit. These are obviously, as we know, the kind of big boosts for renewables over the last decade or so. And so this is a really important one to pay attention to. We talked about solar and wind getting phased out of these credits. Now there's a requirement for it to be placed in service after 2027. And even today, this morning, there's been an ongoing debate on what exactly placed in service means. Historically, it's been 5% of the project needs to be constructed. Now there's a substantial debate on exactly how much of the project needs to be fully in construction in order to qualify for the credit. So TBD on that one. The other thing to note on PTC and ITC is that clean firm, especially firm power, actually seem to stay the course. So nuclear, geothermal, hydro, as well as storage were exempt from the phase outs. So that's pretty good news from a nuclear and geothermal standpoint. Nuclear also had an additional few provisions where the PTC applies to certain advanced nuclear facilities, especially with near urban areas. So that's pretty good news on the nuclear front. Hydrogen now has a deadline to begin construction starting on January 2028. And then carbon capture 45Q actually stayed the course, but the utilization part of that credit, so using CO2 for enhanced oil recovery was increased to match that of sequestration. So previously, the EOR version of 45Q was about $30, and now that's been increased to match utilization at 85, sequestration at $85. So expect to see more interest in the EOR and utilization aspect of carbon capture. 45X stayed the course, but did get phased out for wind specifically. And it also made metallurgical coal for steel making now eligible for the credit. Now, if we go over to the next, other key things to note here, clean fuels, especially biofuels, actually won out, surprisingly. So biofuels credits were extended 2 years through to 2029. And there were a couple changes around land use that actually made the aperture for biofuels a bit wider in the US. Overall, I think consumer electrification around transportation, around home heating and electrification took a pretty hard hit. So a lot of those consumer tax credits have now been phased out before the end of the year. And finally, transferability, which was a bit of an open question mark in the back and forth, that has stayed the course and is not going to be impaired during the phase out periods. And foreign sourcing restrictions have been increased across the board. This is actually a big one. I think that a lot of people haven't been talking about enough, that FEOC restrictions have been significantly increased. This is going to create much higher thresholds, both in terms of cost, in terms of sourcing for key energy supply chains. So China, Russia, Iran, North Korea are on the list, but it's going to make it a lot harder to find the right suppliers, especially given the 2027 deadline as well. So mostly red, mostly orange across the board. Some exceptions, like for biofuels, nuclear, geothermal, storage. And so we can see here that, there's going to be a couple of areas within energy transition that are going to be more emphasized going forward. And surprisingly or unsurprisingly, I think investors had been reading the tea leaves on what was going to come out with this bill. And switching over to what we've published on H1 investment trends, we can actually see the key takeaways and the numbers almost reflect the sectors and the phase outs that were shown in the OBBB. So a couple key takeaways here from the last 6 months. Obviously, policy, like it or not, is a really big driver for the energy innovation space. And so one thing that was a really big takeaway we saw was the end of see and wait and see, not just because the bill has landed, but generally the sentiment around waiting and seeing if investment's going to pick back up, I think for the most part has ended. The second big takeaway was really security, adaptation, and resilience coming into focus. We'll talk more about this, but I think broadly, any sector, any technology, any solution that overlaps with security, adaptation, resilience, there was a lot of significant investor interest. And then third and final, Europe sentiment is strong. The numbers lag on this front, so we'll talk more about that. But generally, there seems to be a lot of investor interest in starting to deploy outside of just the US, Europe, and rest of the world. So those are some of the key takeaways we'll talk about. Kicking off, investment in this first half year period dropped 19% year over year. However, if you zoom out and look at this from a cumulative standpoint, climate investment doesn't look too bad, right? It's crossed $200 billion for the first time. Compare that to the same 5 year period during Clean Tech 1.0, which was about 25 billion. And there's essentially a 10x increase to the overall amount of funding that's gone into this space. So zooming out, big picture investment is still strong, but the growth is linear. The growth is linear and flat, but the slowing is slowing, if that makes sense. Last year, we talked about a 30% drop. This year, we're talking about a 19% drop. So the slowdown is slowing. Now we zoom in to the mega deals, right? So what were the top climate companies, the top deals that got funded this past 6 months? We can see that really strong tie-in to security, resilience, and adaptation. The average top deal size was 30% higher than in H1 2024. So also seeing that shift to quality, that the companies that are doing really well are actually attracting a lot of competitive investor interest. And then I think similar to what we noted with the OBBB, there's a lot of focus on areas that overlap with what this current administration cares about. So energy security, adaptation, resilience. Looking at a couple of the top deals here on the security side, a lot of big deals for nuclear, kind of playing on the power demand story, the load growth story, especially with all of these large loads like data centers coming online. But also playing on that security and geopolitics story, right? That there's now all of a sudden kind of a global race to build a nuclear energy power, not just a nuclear power. So Helion, X Energy, specifically there, made up those top nuclear deals. And then similarly, the other side of security is firming up supply chains. So critical and strategic minerals suppliers like cobalt, Electra on the steel side also raised some pretty big rounds. The other key area we saw in the mega deals was really this story around resilience. Resilience, especially focusing on distributed assets. Again, coming back to that load growth story, how do we bring more power online fast? Well, that comes back to resilience and distributed assets. So Mainspring raised a relatively large round to provide on-site power for critical assets, and base power as well on the storage side also raised a large round. Not on here specifically, we'll talk about that more later, but grid tech to that resiliency story also had its best quarter ever at 316 million. And then last but not least, adaptation also showing up a bit here on the mega deals as well. Colossal Biosciences raised 200 million to reverse extinction. I think one of their recent announcements is trying to reverse the woolly mammoth. So maybe more to see there around adaptation types of plays, especially given we're past the 1.5 degree mark. The last and final key takeaway before we hand it off is really looking a bit closer at US and Europe. It was recently just London Climate Week a few weeks ago. A lot of investor excitement and sentiment around, okay, is Europe going to be the next big opportunity? We were really curious to dig into the numbers to see whether or not that held true from an investment standpoint. And at first I was kind of surprised, I'll be honest. The US investment rose 20%, whereas Europe investment in climate tech actually fell more than 50% compared to the last year. Looking more into the numbers, the reason behind this discrepancy is really growth rounds, that there's a lot of early stage excitement and interest in Europe, but there aren't the growth rounds, the mega deals to match. So a lot of the Series B, Series C, Series D stages, for example, got done in the US, didn't get done as much in Europe, which is what drove that investment differential. But going forward, from a sentiment standpoint, we're hearing and seeing investors, especially at that growth stage, turning their attention towards Europe. And there's a lot more projects starting to get built in Europe as well. 8 out of the 10 largest low carbon cement projects are actually getting built in Europe. So taking advantage of a lot of the regulation and sticks that exist there, and increasingly the carrots that exist there as well. So one to watch. We'll look and see if Europe investment and also project deployment starts to increase around energy and climate.
Thanks, Cam. You're a beast. That was a lot. Thank you, folks, for engaging already. We've had tons of questions in the Q&A, and I'm watching for those, so I see you, and we're going to get to you about the battery, EV, carbon accounting, market-specific implications just in our next section. So you're a click ahead of us. Julia's coming up to chat through all of that next. But we want to hear quickly from y'all. Okay, so get ready for another poll. We love these. First one is supposed to be a little bit like on the nose or pithy or kind of poke fun at all of us a bit. So is all this energy security investment theme, is it a trend or is it a fad? So are we all just trying to be founders fund here, or is all of this conversation around climate meets energy security actually a reason for foundational long-term investment in nuclear gas, critical minerals? Is that a way to shore up our domestic energy sources? Or is it really a kind of full reorientation just to make climate investment a bit more palatable? So what do you guys think? Pop your question in there. And then hopping right on into the second one. What do you think about this US versus Europe funding duel? Kim laid out that there's kind of much more project and foundational industry investment in Europe. In the US, it kind of remains much more disruptive, and we're quite strong on those middle of the stack venture deals and growth deals. How do you think that that's gonna shake out in the future? Will Europe surpass the US? Okay, closing the poll in 3, 2, 1. Let's see what you guys think. And interesting. And Julia, feel free to pop up here if you want to engage in this with me right as we hop into your section. Interesting. Okay, so y'all are definitely in on the long-term energy security theme, not fad. That's like strong polling right there. But maybe we've got some of our yes fad people feel a little more hot take. Let's take a mental note of that one and discuss that when everybody hops back on, because I think that we between our team members have lots of thoughts as well. And then Europe versus US, we got a strong-ish US contingent. But I like that we've got a solid kind of 30-ish% of people saying that EU projects are going to pull ahead. Cool.
Yeah,
Honestly, more divided than anticipated, right? Yeah, awesome.
I know. I think we were giving people too many options there. I do love the 11% of people, though, who said they would be dead even. If that actually turns up in the numbers, I think there will be a special slide on how crazy it is that these are absolutely the same in the next report.
I love it. All right, so we're hopping over to you, Julia, now to chat through all of those investment trends. And if people want to follow along with in incredible detail, look into the chat where we have popped the H1 report link for you to follow through on. And even since we popped that over, I think about 50 of you have downloaded it. So go grab it if you haven't. Okay.
Thanks, Sophie. Yeah, we love getting these real-time stats from the team. Amazing to see. So Kim has given you the big trends. I'm going to dive into a bunch of the numbers. So here are the highlights. We have Series B funding down 29%. Most other series also down, but only growth was up. So that's really interesting to see. That's really, yes, the missing middle is still really difficult. This $45 to $100 million deals, they're still rare. It's still really tough to raise those. So you see investors placing bets much earlier where they're comfortable backing something new with small check sizes, or much later with proven tech and bigger check sizes. Second point is energy is continuing its resurgence. So it's up 13% when most other verticals are down. Climate management and carbon also up. These are smaller sectors in terms of absolute emissions. So this comes as a little bit more of a surprise, but we're going to dig into why that is. And the answer is basically it's software. And then really interesting to see acquisitions doubling compared to the first half of 2024, but it's mostly undisclosed deal sizes and probably bargain hunting. So if we click into the funding, last year at the end of 2024, energy really took the crown as the leading vertical away from transportation. So we had seen transportation leading, now it's energy, and it's staying in that top spot with 35% of funding in the first half of this year. And that's really being driven by the big deals in nuclear and grid tech. So energy was a super positive story, but transportation is still continuing to fall. So you can see it's almost cut in half. And that's off the back of some high profile bankruptcies, Nikola, Northvolt, but it's also just because that funding is moving out of VC. So the big things that were bolstering transportation, like EVs and lithium ion batteries, that's just moving into debt, project finance, much bigger things. It's a pretty similar story in the built environment as well. So you can see that that's down 71%. That's because those big $500 to $600 million deals for data center developers, they were an aberration. They weren't the rule. So now we're thinking more about energy efficiency in that sector and some data center tech. But it's really industry that stood out to me here. That's a huge victory for industry to hold steady because we're talking about difficult funding environments, and this is like the hardest of hard tech. It's stuff that is going to take a long time to pay off. It's things that you have to build, big projects, patient capital, and there's definitely software plays there, but the big deals that Kim was showing you, it's reusable rockets, it's mining, it's steel. Like these are things that need a lot of infrastructure, and they're all pretty traditional in terms of industry funding. So we started to see energy funding creep back up to the highs of 2021 and 22, and that's really thanks to nuclear. There was actually a $650 million deal that we didn't get to put in this chart because it came in so late for TerraPower, which is an SMR startup. For each of these vertical charts, I've given a BBB impact. I'm going to save myself one extra letter and be a BBB person. The impact is pretty mixed. There's more support for geothermal and nuclear, which is what's making up a lot of the VC funding now. And then the sunsetting credits for solar and wind. There could be a silver lining there in that it could mean that the enabling technologies that we're tracking, the things that make those big projects cheaper, more efficient, they could start to see more demand as a lot of the economics are squeezed by losing those tax credits. The big deals in energy were the big deals overall, and all of these could be thought of through that energy security lens. But to highlight industry, Q1 in 2025 was great for industry basically because of the Cobalt and the Stoke deals that you saw in that mega deal slide. The big tickets were still raising for folks, but there's also a lot of software here for logistics, wastewater analysis. It's all of the things that are kind of operating on the margins. So it's less transformation and more iteration. The BBB changes will be pretty bad for industry. Hydrogen was a big part of the decarbonization projects, and the loss of that OSID funding in general is going to make folks really difficult. The CCS credits are still surviving, so you could see more investment in cement, a lot more optimism there, but that's really unlikely to be VC because it's all so much later stage. And still, a lot of the big players here, like Electra, Terra CO2, is around decarbonizing cement. Now, I mentioned that the built environment really took a big hit because of that lack of huge data center deals. Now, that was kind of expected and natural, as we talked about. So energy efficiency is really what is now driving the investment in this sector. And I've said BBB impact yellow because it's kind of giving with one hand and taking away with the other. Obviously, those home energy efficiency credits are now gone, which could have driven a lot on the consumer side. But if electricity prices are rising, which is what some of the early analysis of the bill are saying it will do, then you could start to have big commercial installations be much more concerned about their energy use and their efficiency, which could drive much more of this building energy management investment. And that's what we're seeing a bunch of these startups. So 75F, GridPoint, these are about better managing the energy in buildings. Climate management was also one of our positive stories from the H1 report. And we pack a lot into this sector. It's where a lot of the adaptation companies that we're tracking sit, especially the ones on the software side. So the story here is really adaptation is starting to be something that people are putting money into, especially if it's a software play. That's what was driving a lot of these big deals. So it's things like monitoring ocean data, mapping seabeds, drones to help with O&M for renewables, a lot of really interesting stuff around looking at the world around you and assessing the risk. This may be somewhat controversial, but I've actually said BBB green. And this is quite a nuanced take, so I'll spend a minute on it. This is a pretty long-term view. There's not a lot of policy drivers in this sector. It's mostly corporate driven. It was about reporting and, thinking about emissions and climate risk and sustainable finance. But if the BBB is removing a lot of mitigation options, then you really have to start looking at adaptation and managing your risk. And that's why we think investors are going to move towards this, because they'll be seeing what's on the horizon and knowing that these kinds of solutions are going to be in demand and that there's money to be made there. So a quick review of the most active investors by stage: early stage, late stage, growth. You're seeing a lot of really familiar names there. There hasn't been a lot of change in this slide this year. It's really the people who are super climate committed doubling down. So a lot of these deal totals were built up in 2021 and 22, and there were a ton of deals getting done. And no one's really overtaken that lead from the players like Lower Carbon Capital, Breakthrough Energy, SOSV, Energy Impact Partners, a lot of the usual suspects here. But if we look at exits, there are a couple interesting stories. So you can see that a lot of the acquisitions were just undisclosed, and that's just bargain hunting. There's a lot of people realizing that there's cool tech out there that they can snap up at a much lower price than they would have been able to a few years ago. The Oxy deal is super interesting because Holocene really hadn't raised that much capital, and they were pretty early stage. This is interesting to me as someone who's been following CCS for a while, because we kind of thought they did the same thing with carbon engineering. I was surprised at the time at how fast that acquisition happened, and that it happened then before they had actually gotten to their big commercial scale project. So it's really Oxy shoring up its bets in direct air capture and liquid solvent. With Northvolt, it's about them chopping up their assets and selling them off to people. So this is actually just their industrial, larger batteries for big vehicles. And then Arcadium has gone through a lot, changing names, mergers, and is really being purchased for the asset. On the IPOs, you can see that SPACs are back for things that aren't quite commercial. These are the techs that need to build these huge projects and kind of want a shortcut to accessing those public markets. So you have Terrestrial Energy, which is a small modular nuclear reactor company. And actually, we had Oklo SPACing last year. So kind of a continuation of that trend. So this is what's happening in exits. But now I've given you a lot of my views on what's happening. We want to give you some of yours too.
We're back with another poll. So hop on over here and get ready to put your answers in. We're going to do this one in rapid fire succession. Go with your intuition. Which sectors will grow the most in the coming year? You've got a drop down there. Pop it in. And then moving right on to the second question. We should have a polymarket sub-channel going for this or something like that. But which specific company is most likely to have a successful exit next year or within the next 18 months or so? So give us all your answers. We might be, trading in the back channel here, but no shortcuts. You've got to type it on in. And we're going to close this out in the next 5 seconds. So go with your gut. What do you think is going to be exiting sometime soon? I've been enjoying the Q&A, by the way, and this exit question hits on one that's been posed around where's the liquidity going to come from? How does BBB change any of that? That's really what everyone should be asking. So, okay, we're closing this out in 3, 2, 1. What have we got? Software. Kind adaptation, lower than anticipated. I put adaptation. Grid tech makes sense. We need all of that for the clean firm. We've got some nuclear fanboys and girls over here, and some solid metal and mining. Net, no one knows, right? Or maybe it's all. So I think if we would asked this about 2 years ago, we would have seen a whole lot more in just the straight up software. So really, really interesting to genuinely see this shift over to kind of more real assets and just the electron economy, if you will. And then for our company most likely to have a successful exit, we can loop back on that one. We can loop back on that one in a second. We're going to look in the back channel and then share it back. And I love that most of you guys stayed moot on that one. Fine, keep your answers to yourselves. All right. Last section here. Mark, you want to hop on up to let us know about, we've done a lot of the kind of what just happened, and now no pressure, but over to you for the what's ahead.
Excellent. Thanks, Sophie. So back in January, when we did this webinar, we spent the second half of it just kind of doing our outlook for 2025. We brought everybody back in. We did a discussion. We're going to do the same thing. But before we do that, we're going to grade our homework first. Looking at what we thought back in January when we put out our end of year or beginning of 2025 outlook, we're just going to check in on it really quick. So at the top of the year, we thought this was going to be the new normal, that there was a dramatic drop in 2024 in funding. We thought things would flatten out in 2025, given less federal support in the US and less interest in things like hydrogen. So far, it looks like we're kind of on the money there, but it's a little bit too early to tell. Really, what it probably looks like is a repeat of H1, where sectors that are important to energy security will continue to rise and everything else is going to be kind of flattish. On to the next one, we thought there'd be a growth rebound. This one, we think we got right. It bears out in the numbers, but also, just we're seeing that deals are getting done. Last week, we had a panel. We hosted an event in London called Europe's Energy Moments. And we had a panel where this guy, Lance Ugla, the vice chair of General Atlantic, said that if a business is good, it'll get funding, right? So squinting to try to make things that don't work just doesn't happen. And so we'll talk more about this in our session in a minute, but we're seeing good projects get cash. Next up, it's data center dollars. We thought this was going to be a big deal for built environment, for construction. Really, we kind of got that one wrong so far. They've been huge, but it hasn't been necessarily for the built environment or construction data centers. It's really been for power that has been the real story there. It's kind of one of those Maslow's hierarchy of needs things where, once power is solved, then they'll worry about more construction, making it more efficient, and then environmental issues, et cetera, et cetera. I would highly encourage Sightline users to go onto the Sightline platform. And if you haven't read it yet, read our report called Data Center Powering Models. It's a gem. It genuinely is a really fantastic report on data centers that I'm sure you haven't read yet. It's really unique, really great. Okay, next is transport moves beyond VC. I think this is great. Just yesterday, I was looking in our signals feature on the Sightline platform, and I saw two things that relate to this. That number one is that Liber Mining is testing a trolley system, electric trolley system for their haul trucks, that fully electric haul trucks on mining. So that's definitely not a VC play, as far as I can tell. And also Panasonic is rounding the bend on construction of its Kansas EV battery factory. So things are sort of growing up. And we saw this in Cleantech 1.0, where, eventually VC funding started to die in sort of wind and solar because it started to move on to a different game. Okay, finally, actually, structure the risk away. That's the next one. We're seeing that. We'll talk about this in the panel, but we're seeing a lot of that anecdotally and starting to appear in the numbers. And finally, consolidation continues. Kim, Sophie, and Julia have all mentioned this. I wrote this up in our weekly to our clients last week, where I said consolidation is the word of the day for the entirety of H2 of 2025. And I think this can relate to really kind of any type of consolidation. It can mean companies going out of business. It can mean smaller companies merging to have a fighting chance at things. It can mean tuck-in acquisitions. It can mean triumphant exits. And it also can mean portfolio buys. So where companies get acquired for the portfolios they've built for other companies to try to meet those sunset targets that the US has put in. Okay, so we did pretty good. I don't know, 3 for 7, not bad, with 2 wait and sees. But let's bring the panel back in. Let's bring everybody back in. And what we're going to do is just kind of talk about some of this report card stuff, some of the things we're seeing. But we've got a few questions we'll ask each other. But really, we want to kick it off really just with what is the buzz? What is the zeitgeist? Really, what are we hearing from people out in the market this past week? Sophie, why don't we start with you?
Go with me. Yes, excellent. I mean, right off the cuff, um I promise not all VCs do this, but I took a year-long scheduled vacation for 4 days to the Amazon rainforest, and I came out of the rainforest after hacking through it, and my phone loaded back up with a bunch of messages, and I had like 10 sad boy texts, of people being like, RIP, IRA, it's all over, BBBB, sad face. I'm exaggerating, right? Of course, but it's a bit of don't quite resonate with that, right? So it feels like there's a camp that is always quite attuned to the political machinations who are perhaps pointing to the end of climate as we know it. We just went through this in great detail, right? And as always, my perception is that the excellent founders kind of find a consistent way to find the edge of the market and to find the edge of the thematic net new opportunity. I know that's a trope and it's very easy to kind of pontificate and look from our perspective on it. But I'm firmly in the camp of like, if this thing makes money and it's solving kind of a real need that is not only saves money, right, but also generates net new kind of revenue opportunities, then there'll be folks that want to back that. And so I think it's interesting looking at who's funding these businesses as well and noticing that so much, almost 2/3, I believe, from the last time that we cut this, of funding comes from generalist investors into these growth deals. And as we're thinking about not just the climate venture and equity space shifting, but also the venture fundamental market moving as well with significantly limited liquidity, aka we're not giving money back to our own investors because this has all just been locked up for so long with very few exits. Then you're seeing this split into boutique shops, if you will, right, that tend to be reasonably specialist and reasonably early, and then just a massive capital agglomeration play of larger multi-asset class funds that are able to shift up and down across the spectrum. And so we're very early stage investors at my fund called Planeteer Capital, and we're leaning in hardcore on the really early stage plays in the hopes that they're just more efficient businesses that don't need to raise as much at the A and the B stage. And so we kind of pop over into that. And so we're able to move early and then play with the larger players as those companies kind of accelerate through. So we're always looking at where the market's shifting early. And I think there's a massive amount of opportunity that has just opened up. Call it what you want. And maybe we should have done a poll on what the new name or theme is for this space, but I'm all in on the resilient electrification plays. What about you guys? What's in your kind of back channel? What are people saying to you in the back channel?
I mean, two interesting points to build on there. I think there's the sentiment of getting more creative in energy or climate tech or whatever you want to call it, both from the financing standpoint as well as from the actual what are we funding standpoint. And so from the financing standpoint, in terms of getting creative, we talk a lot about the missing middle. And now we're talking even more about the missing middle in the missing middle. So a few months ago, we launched an investor sentiment survey about this topic. And I think one of the things that came out of that, the missing middle and the missing middle, that it's not just this big universe that's the missing middle, Series B onwards. It's really this 45 to 100 million, or almost demonstration stage that feels like the crux of the missing middle, because naturally it's not something venture investors or equity investors typically want to fund because it's a lot of capital. The return ratio isn't there. And it's also not something that project finance, commercial banks want to fund because it's still just too risky. And so I think what we're hearing now is a year ago was all about like, okay, the missing middle exists. What do we do about it? Now it feels like there's at least companies, investment firms coming out of the woodwork trying to get creative in solving it. One thing we are starting to hear about is growth credit, right? So similar to growth equity and how that's evolved on the equity side of the spectrum, how can something like growth credit solve some of that risk and return ratio coming in at the top co instead of the project level, and then better matching sort of the timelines and non-dilutive needs of some of these hard tech companies. So that's on the financing side, like seeing creativity in how the capital stack is evolving. In terms of what's actually getting funded, what are the areas that investors are now interested in? I think we're seeing a lot of interest, especially from the growth funds that have raised over the last few years, in almost like going back to mature solutions that work, right? So continuing to ride the tailwinds that we're seeing today around, okay, there's a bunch of load growth, there's a bunch of not just like data centers that need to get built, but also generally, I think electrification as a theme is here to stay. And there just needs to be a lot more capacity. The grid needs to be modernized and improved. So how can we get creative on like the types of businesses that have worked, that are mature, that have things that can make money today? And so that's, I think, where we're seeing a lot of investor interest. So on the grids, the reason grid tech has been so hyped up this year, which is like the first time I feel like anyone's been super hyped up about grid tech, is it works today. There's marginal improvements to expand capacity. It can bring capacity online today. And most of this isn't like really hard tech, deep tech stuff. On the other side, we're also seeing more interest kind of reverting back to nature-based solutions. So whereas in the past few years, there was a lot of excitement around things like direct air capture and all these like really crazy ways to remove CO2. Now it seems like we're reverting back to trees. You can grow a tree and it'll suck out CO2. And maybe it's an imperfect solution, but it works today. It can suck out CO2 from the atmosphere today. And so I think those are kind of the themes we're seeing on the what's getting funded and what will continue to get funded is like what will literally work today and generate the thing today, whether it's an electron or CO2 getting sucked out of the air.
Back to basics. Right.
Julie, I'd be curious on your side, we just published that big report on powering models for data centers. Like, what are you seeing in this theme of what works today and what's potentially going to work tomorrow, especially as it relates to the sort of like data center powering story?
Yeah, it's a super interesting question because a lot of what we were seeing was sort of putting off some of the tough decisions. So we were seeing a lot of like gas being installed to run a data center that's next to an existing connection that was vacated by a retiring coal plant, or trying to connect to, grids that aren't as congested, or doing an off-grid solution with a really downsized connection. So it's all of these like, can we find something in the middle of all of these issues? And I think this idea of like punting on the hardest stuff is something you're going to see a lot of. So this idea of like, we'll do gas, it's going to be hydrogen ready. Maybe one day we'll get to the hydrogen, maybe one day we'll get to the CCS, is something that I see a lot of as well in other sectors. So it's like, can we get some emissions reductions, but maybe not go the whole way? So stuff like recycling, I would expect to be doing better, things like incremental efficiency improvements.
Great. And now I think it'd be interesting to kind of land on one final question before we open it up a bit to audience Q&A, which is the bull and the bear case, right? Mark, I'd be curious your take on like, what is the bull case? What is the bear case now that BBB has landed?
Oh man. Okay. I'll give them both. So at least in my view. So the bull case for me is that this lights a fire. I've been saying for a while, I guess, that Trump could be the accidental environmentalist, right? That Holly, in the newsletter yesterday said so much that this could light the fire under all those trying to meet those sunset deadlines put forward by the Triple B. And we saw this in Clean Tech 1.0. that, every time the PTC or ITC would expire, there was a flurry of investment and construction in the years in the run up. And so this could lead to a lot of additional development, and companies buddying up to say, hey, let's try to work together to get these things done across the finish line to meet these deadlines. This could also lead to great results for other markets, right? So it could say, okay, well, this FIAC rule, the foreign entity rule requires, all this stuff for the US, well, forget it. I'm going to go build in other markets where it's a bit easier for me to go build. That's kind of the bull case for what I'm seeing is in terms of growth. The bear case for me is that it's a combination of the timing is just no good. The things can't come together fast enough to meet these sunset requirements for these different policies. But honestly, the other one is everybody gets spooked, and the other one is not enough workers to do the thing, not enough engineers, not enough skilled tradesmen out there to build the stuff. But I think the one I'm concerned most about is these FIAC rules. So I think probably most of us are, at least in the US. But the big difference with Clean Tech 1.0 is that, okay, these policies came in and came out, et cetera, but there was all this blood of sort of, well, call it cheaper kit coming from elsewhere. And so that won't necessarily exist as much this time. And so it'll be a question of whether companies are able to capitalize on these new laws. I think the winner here is honestly probably geo, maybe some nuclear, because, well, even this past week, I've been hearing of brand new companies kicked up saying, hey, we're PE funded, we're tech agnostic, we're a geothermal developer, Fervo figured it out, we're going to go in behind them and do it as well. And so I think sectors like that could do really well. Anyway, what does everybody else think? I think that those are my bull and bear. What do you think, Kim? Or Julia, go for it.
I was just going to piggyback on yours because I'm the non-American in this webinar and say that I actually think the bull case is that everybody else ignores what the US is doing and coalesces around some kind of collective action. So the EIB has a ton of money to spend, and they can spend it, they could shift to spending it on the more aggressive folk stuff that DOE was doing. Europe does the folks bolstered by CBAM. China takes the tech, scales it up, sells it to everybody else. Massive deployment. The bear case, I think, is like a 4-year hiatus. So climate tech continuing to operate on like the US electoral cycle. So low-hanging fruit mitigation, partial solutions, energy efficiency, coal to gas replacements.
I like that your bull case is just taking the strength out of the US and globalizing it, which maybe we could start referring off of some of the Q&A here a little bit, right? So if I had to summarize kind of all of the 20 or so questions that have come in, it's a split of like people asking about specific sectors, which I'll hold on for a second, because if you go into our report, we've done a really deep dive teardown of what we think is going to happen, essentially technology area by technology area. So we'll kind of push those ones on EVs and SAFs and critical minerals and batteries and emissions accounting. We see you and we've already answered that. So go take a peek there and let us know if you have any follow-up questions. But let's keep riffing off of what Julia was just saying there around these like funding gaps, alternative sources. People have been asking about, okay, cool. So if it's not federal, can states fill the gap, right? Kind of classic American style democracy. What about research? Who backs that up? We've seen some private foundations or just individuals popping in or trying to back up universities as their tax exempt status has been kind of further questioned. What about just other novel financing approaches? Anything that you guys are seeing in particular? This isn't quite a financing approach, but I have noticed some private equity small funds that are being raised in real time right now to consolidate the, sub 10 mil ARR style businesses that look essentially identical to their neighbor. And it's not an interesting exit, right? If you're doing sub 10, but if you sum together 5 of them, then you could exit that, right? And so medium interesting strategy, perhaps. Maybe it's a little point in time, but just more consolidation so that you can actually grab some liquidity. I think that we'll see quite a lot of that. I don't think that pushes forward and solves, for climate impacts or outcomes, but financiers will be financiers. What else are you
Yeah.
guys seeing that's kind of funky or new, or the opportunity space is opening up for?
I was gonna just jump on that point as well around like from a consolidation standpoint. It is actually Jigger said this on the Open Circuit podcast, right? It is a time of opportunity from an investment standpoint. You're seeing lower valuations. You're still seeing like good fundamental companies that have good technologies, probably good businesses as well, but maybe aren't going to hit the hockey stick. Like that's a great time for consolidation, and we're seeing more private equity firms picking this up. So a lot of these acquisitions, a lot of these exits have actually been PE buyouts. Like recently, TPG acquired Aurora Energy, which is like a energy data company. General Atlantic bought up Gresby, which is like a real estate sustainability play. So you're going to see them essentially through those entities go out and acquire a bunch of smaller scale companies as well. So I think that's one interesting trend. But yeah, that's I think the key piece we haven't hit on yet.
I know we're out of time, but I'll just say watch the states. There's some really fascinating things happening at the state level as well. Find me after. Happy to talk about them. I think they're totally fun to geek out on. But yeah,
This is the time where it gets interesting. I don't know about you
totally,
guys, but
totally.
the kind of just like straight up and out where it felt like everything was getting funded felt a little bit queasy. We've kind of seen
Mm.
flattening and reality hit. And now it's time for some breakout winners and some consolidation and some money really getting back into pockets. And like, I think this is where it gets really cool. So glad you guys are with us. We're set and locked in stone with the CTVC name for good or for bad for forever. So we will not be rebranding that. So you guys can call this kind of investment trend set, whatever you want. I appreciate people coming at this from lots of different perspectives in the chat, right? This is a theme, not an industry, as we say over and over again. And we're going to be cranking out the content all summer and into the new year. So Kim, any last words as we wrap this webinar up, which will be posted to YouTube if there are
Yeah.
specific clips that you want to double click into afterwards, of course.
Yeah. Just wanted to, I mean, say thank you. I know obviously an exciting and interesting time to be in this space. So thank you all for joining us. Thank you, Mark, Julia, Sophie. Awesome job moderating. For those who are interested as well in learning more about the behind the scenes of the research, the data, actually being able to see all of what we've talked about in real time. We're tracking investment, we're tracking project deployment, we're tracking offtake demand across all of these key sectors. Reach out, send us a note at hello@sightlineclimate.com. We'd love to chat with you and go further behind the scenes around all of this research that we're doing at Sightline. And we'll also share over some of the follow-ups, some of the ways to engage with us if you've joined the webinar. So any of the questions, any of the takeaways that you might have missed, we'll share over all of that in the follow-up. So do send us a note, hello@sightlineclimate.com. We'd love to hear from you. And if you are interested in chatting more with us about our research and what we're hearing, definitely send us a note. So thanks everyone for joining, and we'll be back in your inboxes very soon.
See you soon. Thanks.